Hello, everyone. I'm Aaron Sachs. I'm a senior manager in our Hillsborough office and one of the leaders of our nonprofit team. I want to welcome you all to our presentation today, the 2024 Annual GAAP Update for Not-for-Profit Organizations. Today, I'll be presenting with fellow members of our nonprofit group, Shelly Ombrambowski and Matt Currier, and we'll be walking through some of the recent updates to US GAAP and sharing best practices and requirements for ensuring compliance with reporting standards. But first, a little about Jones Roth. Our firm has been serving clients in the Pacific Northwest for nearly 80 years. We have 3 offices across Oregon and a team of about 100 members. Our team is niche focused, which allows us to specialize in industries and serve our clients with the technical expertise of a large firm while providing the quality service you expect of a local firm. Our nonprofit group is one of the largest in the firm. We have a diverse team of CPAs and business advisors dedicated to serving our nonprofit clients. Now, to introduce my fellow presenters today, Shelly, we'll start with you.
Hi, I'm Shelly Ombrambowski, a manager in our nonprofit niche team, and I'm based out of the Bend office.
Hi, I'm Matt Currier. I'm a manager in the nonprofit niche, and I'm based out of the Eugene office.
All right, thank you, Shelly and Matt. We'll go ahead and get started. So first, let's take a quick look at what we'll be covering today. We'll be discussing the new accounting standard for measurement of credit losses under the new estimated loss methodology known as CECL. Next, we'll be reviewing the recent changes to lease accounting standards in the past couple of years. And finally, we'll be providing an overview of revenue recognition principles for not-for-profit entities. Please feel free to submit questions throughout the presentation. Be sure to use the questions function on your screen to do this, not the chat feature. The chat feature will go to everybody and be visible by all, where the questions will go just to our team. We'll have a team member monitoring those questions and do our best to address them as they come in. If we don't get to your question, please feel free to reach out to us after the presentation. All right, we'll kick things off by talking about the new current expected credit loss model, often referred to as CECL. This new standard changes the way both for-profit and not-for-profit organizations estimate allowances for losses on certain financial assets, like trade accounts receivable. The effective date for all entities is fiscal years beginning after December 15th, 22. So that means entities with calendar year 2023 and June 30 or September 30, 2024 year ends will need to implement the new standard from the start of those fiscal years. The new standard requires that entities look at lifetime expected credit losses of the financial assets held at the reporting date. In the case of trade accounts receivable, this generally means estimating a reserve for losses, even if there aren't any particular receivables at the report date where a loss is probable. This is a major difference from previous GAAP, where we followed the incurred loss model. This meant that the allowance for losses only considered receivables where it was probable that collection wasn't going to happen. So let's compare the lifetime expected credit loss concept to the old incurred loss model on the next slide. All right, we'll start with previous GAAP. So in the past, you would have looked at the accounts receivable aging and evaluated whether there were any specific balances where collection was uncertain. Based on that assessment, you would record an allowance for doubtful accounts for those receivables where loss was determined to be probable. So under CECL, the CECL model, we're not just considering probable losses. Instead, we have to create an estimate based on historical experience. That is looking at what collection rates for similar receivables have been in the past. But in addition to that, you're also looking at current conditions, meaning is there anything different about the current environment that could impact collectability that hasn't existed in the past? And also, we're looking at reasonable and supportable forecasts about the future. So for example, is the regulatory environment or economy trending in a way that needs to be factored in as well. So now let's look at the scope of this new standard. So we already discussed that trade accounts receivable is an example, but outside of that, what exactly is a financial asset? And what's within the scope of the new CECL model? So the new standard applies to financial assets measured at amortized cost, such as loans and notes receivable, held-to-maturity securities, contract assets, certain leases where the not-for-profit serves as the lessor. Receivables originating from exchange revenue transactions is where we'll typically see CECL apply to nonprofits. So later in our presentation, we'll distinguish between exchange revenue, where those trade receivables originate from, versus contribution revenue, where you'll have promises to give or grants receivable. There are some specific exclusions from CECL model that are out of its scope. So those include contributions and pledges receivable, which are technically termed promises to give, most grants receivable, financial assets measured at fair value, certain loans and receivables between entities that are under common control, and operating leases where the not-for-profit serves as the lessor. So I want to emphasize that receivables related to contribution revenue, such as grants or pledges, also known as promises to give, these are not subject to CECL. They're specifically excluded from the standard. All right, so step one is to determine if we even have financial assets that are subject to CECL in applying this model. So if we do, we must pool or group financial assets that share similar risk characteristics when developing an estimate for the allowance of expected credit losses. Examples of risk characteristics include age, term, size, geographical location, etc. There's no specific method or number of pools prescribed in the guidance, so there is some latitude in how you go about this. If a financial asset doesn't share similar risk characteristics with other financial assets held by the nonprofit, then only then should it be evaluated for expected credit losses on an individual basis. So as we discussed before, we need to consider historical loss information, adjust for any differing current conditions, and then also take into account forecasts about future events that could impact collectability. And then that arrives at our estimate for credit losses. So generally looking at historical loss rates is a great place to start. From there, you can adjust for any factors related to current or expected future conditions. So lots of steps there, but that does simplify it, thinking about it in that framework. So now let's look at a practical example for how we might estimate credit losses for trade accounts receivable. So Nonprofit Z provides counseling services to clients. Payment is due within 30 days of the date the services are rendered. Nonprofit Z has evaluated current and forecasted economic conditions that impact client ability to pay. Based on improving economic conditions, management expects that actual loss rates will be approximately 10% lower in comparison to the historical loss rate below for each aging category. So we started with the historical loss rates, and then based on the data in the table below, the historical data, since we believe the current and forecasted conditions are more favorable to collectability, we're adjusting those historical rates accordingly downward by that 10% amount that we indicated. All right, so Nonprofit Z pools trade receivables using age as a risk criteria and estimates credit losses for each pool by applying expected credit loss rates. So note that the risk pooling method used in this example was based on the aging buckets of those receivable. The older the receivable, the higher the risk of non-collection. So this is not a required method, but certainly is a commonly used and effective way to pool receivables based on risk. When implementing this new standard, it's important to note there is no minimum recognition threshold for estimated credit losses. So that means we can't just say we're going to ignore it because the expected credit losses are immaterial without actually having first gone through the process of estimating or finding the estimate first. So that being said, you might estimate the allowance for credit losses using the new CECL model and then determine that the allowance is completely immaterial. So in that case, you could opt to not record the allowance. However, the process of estimation using the new model still needs to happen first in order to make that determination. All right, this flow chart is going to illustrate the process for estimating credit losses under the CECL model. So we start first by determining if the applicable financial assets even exist at the report date. Next, we create risk pools for our financial assets. Then we develop and apply our estimation methodology. From that, we record the allowance for estimated losses. And then we assess and update the allowance at each reporting date. So this is certainly something that's an ongoing thing that you want to be doing at least at the end of each reporting day, updating that and making sure that that estimation process is happening. There are some additional considerations in the year that it's being implemented, which for a lot of nonprofits, they're either going through it right now or will be shortly. So a modified retrospective approach is generally required, which calls for a cumulative effect adjustment to the beginning net assets for the earliest period presented on the financials. So that's especially important to consider if you have comparative financials. The new standard also requires additional qualitative disclosures to help financial statement users understand how the estimate was determined. So another consideration, a cumulative effect adjustment may not be necessary when the financial impact of implementing the new standard isn't material. There are some enhanced disclosures that are required under the new standard as well. So a few of the key requirements are listed here on this slide and primarily relate to disclosure of information about how management came up with the estimate for credit losses. That is, how was the estimate developed, what factors were considered, how were the financial assets pooled based on risk, etc. So this slide includes some of the key disclosures, but it's certainly not all encompassing. There is quite a bit to it. All right. Well, next we'll be discussing recent changes in the lease standard over the past couple years. Matt, I'll go ahead and turn it over to you.
All right, thanks, Aaron. So I'm going to be talking about FASB ASC 842 leases. And so to start, I'm just going to go over why was there this change? What is the purpose of this new standard? And the purpose of the updated accounting standard is to increase transparency and comparability among organizations by recognizing lease assets and lease liabilities on the statement of financial position and disclosing key information about leasing agreements. The main difference between previous GAAP and the updated standards is the recognition of those lease assets and lease liabilities by lessees for those leases classified as operating leases under previous GAAP. The effective date for the new standard was for fiscal years beginning after December 15th, 2021. So hopefully this is more a refresher for everyone instead of learning something new. And as far as lessor accounting goes, there's really no significant changes to lessor accounting under ASC 842. The existing lease classifications are still retained, which is the sales type, direct financing, and operating leases. And the vast majority of operating leases should remain classified as operating leases, and lessors will continue to recognize income on a generally straight line basis over the term of the lease. There are some modifications to align with revenue recognition guidance, but in general, lessor accounting is unchanged. And so because of that, we're going to focus more on lessee accounting today. And the general provisions are that you're going to recognize the assets and liabilities that arise from leases, except for leases with a term of 12 months or less, where you've made an election. But you can't do that if you're reasonably certain that you're going to extend that lease beyond the original 12-month term. Lessees will be required to report on their statement of financial position a right-of-use asset and a lease liability, and lessees will be required to classify all leases as either finance or operating leases. And so how do you do that? Well, the way you determine it is, if a lease meets any of the following, then it is considered a finance lease for the lessee and a sales-type lease for the lessor. This includes a transfer of ownership at the end of the lease term, option to purchase that the lessee is reasonably certain to exercise, a lease term that is for the major part of the remaining economical life of the asset, and the guidance says that 75% is a reasonable threshold for that, or if the present value of lease payments plus any guaranteed residual value equals or exceeds substantially all the fair value of the asset. And the guidance says 90% is a good threshold for substantially all. And next, I'm just going to give you a short rundown of what this looks like in your financial statements. So for finance leases, on the statement of financial position, you're going to have your right-of-use asset measured at the present value of lease payments and your lease liability measured at the present value of lease payments. Statement of activities, you're going to have two items. You're going to have the interest on the lease liability, and it's going to be separate from the amortization of the RU asset. And on the statement of cash flows, you're going to have your cash paid for interest and any variable lease payments in the operating section, while cash paid for the principal portion of the lease liability is going to be in the financing section. Operating leases, the statement of financial position is the same. You're still going to have your right-of-use assets measured at present value of lease payments and the lease liability measured at the present value of lease payments. The difference comes in on the statement of activities. There's only going to be a single lease cost, and it's allocated over the lease term on a generally straight line basis. And similarly, there's only going to be one line on your statement of cash flows, and it's the cash paid for lease payments, and it's going to go in the operating section. So I've mentioned present value a couple of times now. So how do we determine that? How do we determine what the rate we're going to use is? And it's relatively simple. You're either going to use the implicit rate of the lessor, which you're probably not going to know. So you're either then going to use your incremental borrowing rate, and that's for a similar loan with similar terms and similar economic conditions. Or if you can't get that information, you can also use the risk-free rate if your incremental borrowing rate is either not available and you have to make an election to do that. And you can also use a portfolio approach when doing this to simplify your accounting. Next, I'm going to go through an example, give you some basic facts that apply to both, and then show you what the difference would be between an operating and a finance lease. So these are the facts. This is going to be the same for both types of leases. And in this case, the lessee has entered into a 10-year lease of an asset. The lease payments are $50,000 a year, and they're all payable at the beginning of the year. The rate implicit in the lease is not readily determinable, so the lessee has determined what their incremental borrowing rate is instead, and that is 5.87%. So at the start of the lease, the lessee makes the lease payment for the first year, which is that $50,000, and measures the lease liability at the present value of the remaining 9 payments of $50,000, discounted at that rate of 5.8%, which turns out to be around $342,000. The lessee also measures a right-of-use asset at $392,000, which is the measurement of the lease liability plus that first payment because it's due at the beginning of the lease. And showing you an example, this is what the journal entries are going to look like. You know, you're recording the lease asset and the lease liability at that original value. And then since the first cash payment is due at the start of the lease, you're going to also record that. So at this point, the lease liability and the lease asset don't match. Okay, and so now I'm going to talk about what it would look differently under a finance lease or an operating lease, starting with the finance lease. So we have this wonderful amortization schedule, and a couple of things I want to point out it. One, there's separate columns for the right of use asset and the lease liability, and that's because they're going to be going down at separate rates. The RU asset is going to be amortized on a straight line basis, and you can see that in column 2. It's going to go down by about $39,000 every year, while the liability is going to be going down by the effective interest method. And so what are those first ones going to look like? So under the finance lease, the lessee depreciates its asset on a straight line basis. So therefore, the right of use asset would be amortized on a straight line basis over the 10-year lease term in this example. And the lease liabilities increase in year 1 to reflect that interest on the liability. And as you can see here, this is what that entry would look like. So you got that straight line amortization. This entry is going to look the same pretty much every year. Obviously, there'll be some small rounding differences. And in this case, you're also recording the interest expense. And you do it the same way you would for, a normal kind of, notes payable, where you're just going to take the liability balance and multiply it by the interest rate. And as I mentioned before, the RU asset is just depreciated straight line or amortized straight line, which is just that $392,000 divided by the 10 years. And the interest expense calculated like normal interest expense, you take the balance of the liability times the interest rate. And so one thing I want to point out, and this is common for finance leases, where the right of use asset and the lease liability do not match, and in general, they're not going to match in these examples. This is different where the operating leases, where generally the RU asset and lease liability will match. Okay, and now we're going to go over an example of what the operating lease will look like. So similar setup, but you notice it's a little different. For one, there's a combined column for the RU asset and lease liability, because like I mentioned before, they're going to be going down at the same rate. And this time, instead of the asset being amortized straight line, you're amortizing the total lease cost straight line. So in this example, because it's relatively simple, it's $500,000 in total lease costs divided by 10 years. So each year you're going to have that $50,000 lease cost. And that's what you're going to record as an expense. And it says interest incurred on the lease liability here, but keep in mind for operating leases, you're not actually recording interest expense. And I'll show you an example of that on the next slide. So as I mentioned before, pretty simple. Total cost of the lease is $500,000. That's how much you're going to actually make payments on. And so the lease expense is just that $500,000 divided by the 10 years, $50,000. And so the journal entry for that is you have your lease expense, the $50,000. Your RU asset is going to be reduced by about $30,000, and the lease liability is going to be increased by the $20,000. And this is where that interest comes from. It's similar to the finance lease. Every year you're going to be increasing the lease liability by what that interest would be. And you calculate it the same as you do for the finance lease. In this case, the lease expense, $500,000 divided by the 10 years. And then the lease liability change is just, once again, the balance of the liability times the interest rate. And you may be thinking, well, wait, you said that the lease liability and the RU asset should be the same. How does that work if the lease liability is being increased? And it's a lot more clear in the second year entries here. You can see, once again, we're recording just that $50,000 lease expense as our only expense. You're reducing the right of use asset by around $31,000. And yes, you are increasing the lease liability by that $18,000, which represents the interest. But then you're also applying that $50,000 cash payment against the liability. And so this is why they end up being the same balance at the end of the year. And once again, that $50,000 is going to be the same every year because it's a simple example, total payments divided by the 10 years. The right of use asset, you can create an amortization schedule for it, but you may have also noticed it's literally just the difference between the lease expense and the lease liability. And the lease liability amount is a little easier to calculate. and then you're just reducing the lease liability by the amount of cash you actually pay. And so as I mentioned, for this operating lease, the lease liability and the lease asset are going to be the same. Obviously, this is a pretty simple example. There's no escalating lease payments or weird balloon payments or any other terms like that. So just keep in mind that it won't always be the case, but in general, your lease asset and lease liability should be the same in an operating lease. And now just to give you, a little more detailed look of what this looks like on your statement of financial position, usually in your PP&E section, you're going to have your finance lease ROU assets separate from your operating lease ROU assets. And same in the liability section, your current liabilities will have a separate line for finance lease liabilities and operating lease liabilities. And then your non-current liabilities will be split the same way, where you're splitting out your finance lease liabilities and your operating lease liabilities. All right, and that's all I have for you on leases. Shelley's going to give you some information on revenue recognition.
Thanks, Matt. Next, we're going to discuss revenue recognition for not-for-profit organizations. First, we're going to go through the difference between contributions and exchange transactions. It's imperative to properly classify all revenue streams to ensure the right revenue recognition standards are followed. Determination between contributions and exchange transactions is the first step in this process. Contributions follow topic 958605, which is applicable to nonprofits, and exchange revenues follow topic 606, which is the revenue guidance generally followed by other organizations and for-profit businesses. Common exchange revenues could be tuition, room and board, or service fees. And remember, grants can be either contributions or exchange transactions, and determining the right classification can have a big impact on recognizing revenues, as different guidance is required depending on that assessment. The biggest difference in determining if a transaction is a contribution or an exchange transaction is determining if the transfer is reciprocal. Contributions are not reciprocal, and exchange transactions are reciprocal, based on whether or not the resource provider receives commensurate value in return for the transferred assets. The type of resource provider does not factor into the determination. Benefits received by the general public do not equate to commensurate value being received by the resource provider. And executing the resource provider's mission does not mean commensurate value is received. An exchange transaction means you provide me this value and I'll provide you this value in return, not a contribution. A contribution means I'm providing you this value and I expect nothing in return other than the warm and fuzzies, of course. We care because properly distinguishing between the two means you are properly recognizing revenue, which can drastically change the financial statements depending on the size of the grant or contract. This chart comes from the Nonprofit Accounting Professional Standards as a template to work from in determining exchange transactions versus contributions. Why is this all important? Well, contribution and exchange revenues have different revenue recognition principles. For contributions, FASB generally requires measuring contributions received at the fair value of the assets or services received or promised, or the fair value of the liability satisfied. Contributions are recognized as revenues or gains in the period they are received, even if the donor has restricted their use and the restriction will be met in a future reporting period. That is, none are deferred. As a result, contributions are recorded immediately, either as an increase in net assets without donor restrictions or net assets with donor restrictions, depending on the nature of the donor restriction, if any. Grants can fall into either category, so we must look at the substance of the agreement. And for exchange transactions, then 606 applies, and the 5-step model is applied, which we will discuss next. This is the FASB's decision tree for determining proper accounting of a grant or contract. You can see the first step is determining if commensurate value is received. If so, then it is an exchange transaction, and you will follow recognition rules in ASC 606. If not, then you continue to determine if the amount is a contribution or other type of revenue. So let's say we determine it is an exchange transaction. Let's walk through revenue recognition for exchange transactions. This is the 5-step model for recognition of revenue from contracts with customers, aka exchange revenue, subject to ASC 606. First, identify if a contract exists, which means, does the transaction have true economic substance? Next, identify the performance obligation or obligations in the contract, whether implied or written. Each must be distinct and identifiable. Then, determine the transaction price. Then, allocation of the transaction price to the various performance obligations in the contract. And then finally, recognize the revenue when or as the performance obligations are satisfied. We want to point out that trade receivables related to exchange transactions, as Aaron mentioned earlier, would be subject to CECL. Under 606, revenue is recognized either as or when the performance obligation is satisfied, either over time or at a point in time. Revenue is recognized over time if one of the following are met. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. The entity's performance creates or enhances an asset, for example, work in process, that the customer controls as the asset is created or enhanced. Or the entity's performance does not create an asset with an alternative use to the entity. For each performance obligation satisfied over time, an entity should recognize revenue over time by measuring the progress toward complete satisfaction of that performance obligation. The objective when measuring progress is to depict an entity's performance in transferring control of goods or services promised to a customer. That is essentially the satisfaction of the entity's performance obligation. And if none of those are met, then revenue is recognized at a point in time. Going back to our decision tree, let's say after walking through the questions on the left, we determine the transaction is a contribution. Let's walk through revenue recognition for contributions. For contributions, the decision tree continues to determine whether the contribution is conditional or unconditional based on whether the agreement contains a donor-imposed condition, which is different from a donor restriction, and we will discuss that later. So, an entity determines whether a contribution is conditional on the basis of whether an agreement includes both a barrier that must be overcome and either a right of return of assets transferred or a right of release of a promisor's obligation to transfer those assets. The presence of both a barrier and a right of return or right of release indicates that a recipient is not entitled to the transferred assets until it has overcome the barrier in that agreement. So, how do we determine whether an agreement contains a barrier? Indicators of barriers include the inclusion of a measurable performance-related barrier. For example, a requirement that indicates that a recipient's entitlement to transferred assets is contingent upon the achievement of a certain level of service, such as 1,000 meals per week for a soup kitchen, or a stipulation that the recipient is entitled to the assets only upon the occurrence of an identified event, such as a matching requirement, which we see quite often. Other indicators of barriers are limited discretion on how you conduct the activity. This is more specific than the general activity that is being conducted by the recipient or the time frame in which the contribution must be used. Those are donor-imposed restrictions. Examples would be a requirement to follow specific guidelines about qualifying allowable expenses, a requirement to hire specific individuals as part of the workforce conducting the activity, or a specific protocol that must be adhered to. Lastly, another indicator of a barrier would be whether a stipulation is related to the purpose of the agreement. It's important to note that this indicator generally excludes administrative tasks and trivial stipulations, such as annual reporting requirements or ongoing performance reporting. It's important to distinguish between unconditional and conditional contributions, because recognition of revenue only occurs when the contributions are unconditional. Unconditional contributions are recognized as revenue when the amount is received or promise is made at fair value. There may be donor restrictions to consider. However, conditional contributions are not recognized until the conditions are substantially met, in effect, becoming no longer conditional. So we just discussed what is considered a condition. This is different from a donor restriction. A donor restriction limits the use of the contribution to a specific activity or time, but doesn't place limitations on how the activity is performed or when the organization is entitled to the revenue. It does not impact revenue recognition. Unlike a condition, which includes the barrier and the right of return before the organization is entitled to the funds. So back to our decision tree. Let's assume we have determined the contribution is unconditional. It does not contain donor-imposed conditions. The next step of the process is then to determine if there are any donor-imposed restrictions and to recognize the revenue within the appropriate net asset class. For donor restrictions, the revenue is still recognized, but the amounts are tracked in net assets with donor restrictions until restrictions are satisfied, at which time the amounts are released to net assets without donor restriction. All right, now I will turn it back over to Aaron to close the session.
All right. Thank you, Shelley. In closing, I'd like to say thank you to Shelley and Matt for sharing their expertise today. We covered some pretty intense topics, so we will be sharing slides after this presentation, just so you'll have those for reference to go back at a later point in time. A big thank you to all of our attendees also who joined us today and submitted some really great questions. Also, please don't hesitate to reach out and ask us if you have any questions that we didn't have time to address in the Q&A portion of this. Thank you for your time and have a great weekend, everyone.